So continuing with the working capital cycle, you've bought your goods and so now they're parked in the warehouse, and I will just call it inventory. Now by inventory, I'm not referring just to the physical stock, but this is the part of the working capital cycle where you have factories and warehouses. Now if you do have inventory, the value of that inventory could be going up and down according to exchange rates. So if you have copper, zinc, lead, aluminium, gold, it's probably dollar denominated. So if your balance sheet is in sterling, euros, rand, or a non-dollar currency, as the dollar moves up and down, the value of the asset on your balance sheet will go up and down as well. So you want to make sure that that dollar asset is hedged with a dollar liability, or the FX rate is hedged. And this is where we come across translation exposure. So when I translate your assets or liabilities back to your reporting currency, have you made money or lost money? Now this is just a paper gain or loss. It's not a real cash loss until you actually sell the asset or close out the liability. Now, inventory is being kept in a factory. Is the factory in your domestic country or in a foreign country? You probably have workers there. How do you pay them? In their local currency. Well, does your revenue generate that local currency, or are you just hoping that it will keep depreciating and it will be cheaper to pay the workers? If it's not, if you do not have matching income, then you want to look at hedging through foreign exchange. So translation risk, transaction risk, hedging of cash flows, maybe the cost of paying foreign taxes, pension funds, foreign debt. There's a lot of risk at this part of the working capital cycle, so figure out how to manage it.